Hey everyone, I'm Yaman Tashtabar. Nvidia reports earnings tomorrow after the close, and while the market is brimming with optimism, I'm here to offer a contrarian perspective. I recently published a detailed article on Seeking Alpha, link in the description, where I argue that even as global AI infrastructure spending continues to rise, Nvidia's revenue may decline. This video builds upon that thesis, examining the shifting dynamics in AI spending, competitive pressures, and valuation concerns. Let's delve into the details. In my Seeking Alpha article, I highlight a critical point. AI spending is growing, but NVIDIA may not be the primary beneficiary going forward. Analysts project that global AI chip spending will reach $150 to $200 billion by 2027, up from approximately $50 to $60 billion in 2024. However, the composition of this spending is changing. The initial phase of AI adoption focused on training large models, a segment where NVIDIA's GPUs excelled. Now, the emphasis is shifting towards inference workloads, which are more cost sensitive and can be handled by alternative solutions. For instance, AWS is promoting its Trainium chips, claiming similar performance to NVIDIA's H100 GPUs, but at just 25% of the cost. This move targets customers with simpler inference tasks, potentially eroding NVIDIA's market share in this segment. Moreover, Meta is testing its first in-house AI training chip, aiming to reduce reliance on NVIDIA and lower infrastructure costs. Broadcom is also offering customizable AI chip platforms, enabling large customers to develop their own AI silicon. These developments suggest that while AI spending is increasing, a significant portion is being allocated to custom silicon and alternative solutions rather than NVIDIA's high margin GPUs. Turning to NVIDIA's upcoming earnings. Revenue. Analysts expect $43.3 billion, a 66% year-over-year increase. Earnings per share is forecasted at 73 cents, up from 61 cents a year ago. While these numbers appear robust, they reflect a deceleration compared to previous quarters. Additionally, the whispered number, an informal yet often more accurate earnings expectation, is slightly higher, suggesting that anything less could disappoint investors. Given the high expectations, any miss on revenue or guidance could lead to a significant stock pullback. NVIDIA faces substantial challenges due to US export restrictions, particularly concerning its H20 chips designed for the Chinese market. The company announced a $5.5 billion inventory write-down related to unsellable H20 chips. Furthermore, CEO Jensen Huang indicated that the company had to forego $15 billion in potential sales due to these restrictions. These figures underscore the significant impact of geopolitical factors on NVIDIA's revenue, especially considering that China has been a major market for its products. Major cloud service providers or hyperscalers are reassessing their capital expenditures, which could affect NVIDIA's future sales. Microsoft has paused or delayed several data center projects globally, including in the US, UK, and Asia, due to the power constraints and the reevaluation of infrastructure needs. Meta has indicated that its capex for 2025 will be flat or modestly higher, focusing on efficiency and cost optimization. These shifts suggest that the initial surge in AI infrastructure spending may be tapering off, leading to a more cautious approach in deploying capital for AI-related hardware. NVIDIA's dominance in the AI chip market is being challenged on multiple fronts. Amazon's Trainium chips offer a cost-effective alternative for inference tasks. Meta's in-house AI training chip aims to reduce dependence on NVIDIA and lower operational costs. And Broadcom's customizable AI chip platforms enable large customers to develop tailored solutions, potentially bypassing NVIDIA's offerings. These developments indicate a trend towards diversification and cost optimization, which could erode NVIDIA's market share and pricing power over time. Despite these challenges, NVIDIA's stock has experienced significant growth, trading at a high price-to-earnings ratio. This valuation reflects investor expectations of continued exponential growth, which may not be sustainable given the emerging headwinds. Any earnings miss or downward revision in guidance could trigger a significant correction, as the current stock price may not accurately reflect the company's future growth prospects. In conclusion, while Nvidia has been a leader in the AI chip market, several factors suggest that its stock may be overvalued at current levels. Shifting AI spending patterns, favoring cost-effective and customized solutions, geopolitical risks impacting revenue from key markets like China, and normalization of hyperscaler capital expenditures leading to more cautious spending. I recommend investors consider taking profits or reducing exposure ahead of the earnings announcement. For a more detailed analysis, please read my full article on Seeking Alpha, link in the description. If you found this video helpful, like, comment, and subscribe to the channel. Also, follow me on X at Yaman Tazdabar for real-time updates and insights. Thanks for watching, and I'll see you in the next video.